Alright, well, I guess we should start the module by, well, defining the reasons as of why I believe that the best decision you can take in order to become a part-time trader is to move away from intraday trading. I know that intraday trading, the intraday charts are more glamorous, more sexy, so to speak. But again, I believe that intraday trading is really not for part-time traders, and there are quite a few specific reasons as of why well, I make this bold statement. Well, which is exactly what I'm gonna try to nail down on this video. First of all, there is no such a thing as sitting on your trading station, early in the morning to take a quick trade before breakfast, fish a quick 10-15 pips out of the market, and to be done for the day so you can merrily walk away from your computer and go to your day job. All right, that's just not feasible. If anyone has led you to believe that, again, you can take a quick trade before breakfast in 20-30 minutes and that's about it, you are done for the day, I'm sorry, but that's just not logical thinking. All right, that's wishful thinking. The thing is that there is plenty of stuff going on from an intraday trading point of view. Okay, on an intraday basis, there is plenty of random market noise on the shorter time frames. Then you have the news announcements that are being released every day and actually multiple times throughout the day, and you're going to be experiencing plenty of market interruptions from an intraday point of view. All right, so it's not as easy as just firing off your charting platform, take a quick trade, and set your stop loss, set your profit taking levels, and that's it. You are done for the day. I'm sorry, but it's not that easy. Again, that's wishful thinking, and intraday trading takes a little bit more than that to make it work. That's precisely why I say that the best decision you can take is to move away from the intraday charts and to focus on to the daily time frame, all right, the weekly time frame, and even the monthly time frame. This may be a little bit too long-term chart for most of you, so we are going to be focusing mostly on the daily and the weekly charts. The thing is that they are easier to search for trades, and once you've actually find a profitable trading opportunity, it is much easier to manage that trade. All right, now, why is it easier to search for trading opportunities as a part-time trader from the long-term charts? Well, by definition, the daily, the weekly time frames move slowly. All right, trading opportunities, trading setups, they do take their time to fully develop, okay, to fully present themselves. So you have plenty of time to seize the opportunity, to gauge the validity of a setup, whereas intraday traders need to take decisions on the fly. All right, the last thing you want to do is to stress yourself. If you only have 20 or 30 minutes per day to dedicate to your forex charts, the last thing you want to do is to stress yourself thinking or knowing that you need to take a decision right now, because you just don't have that much time to monitor your forex charts. Okay, so since the trading opportunities on the daily or the weekly charts take their time to develop, okay, the timing factor is not as crucial as it is on intraday trading. All right, whenever you are searching for intraday trading setups, intraday trading opportunities, the timing factor is crucial. Either you nail down your entry point on the very minute the signal comes by, okay, your system, your particular trading system gives you the entry signal. Well, if you do not nail down the entry at that precise moment, chances are you're gonna miss the intraday trading opportunity altogether. Well, that doesn't happen if you trade off the daily or the weekly. Again, because they move slowly and you have plenty of time to take that trade. Okay? But not only that, once you are actually involved in a trade, it's going to be much easier to manage that trade. Please don't make the mistake of believing that, a trader's job is done once he actually clicks on the buy or the sell button. Okay, basically once he jumps into a trade. Once you are actually involved in that position, you need to manage that position. All right, you need to follow the trade in order to know when to let the profits run, when to actually cut a trade short, or when to actually exit out the trade altogether in case, well, the trade begins to lose momentum or turns around against your best interest, etc., etc. Okay, again, you need to manage that trade. So if you just have 20 or 30 minutes per day and you want to be an intraday trader, well, chances are you are not going to be able to close that trade within 20 minutes, right? I mean, that's just not possible, okay? The trade is going to span for a little bit longer, 1 hour, 2 hours, 3 hours, whatever it might be. But at any rate, it's certainly going to be way more than just 20 minutes. On the other hand, if you trade off the daily or weekly time frames, you can come back to your trading platform once a day, take a quick look into that trade, okay, into that position, 15, 20, 30 minutes, way more than enough to decide whether you let it run, you cut it short, you move your stop loss, whatever decision you may take. Okay, but at any rate, it's certainly more time friendly. And now I'd like to dispel a myth that I keep on reading on the internet forums, on forex blogs. There is just so much misinformation out there. It's just scary. But anyway, like I say, there is a popular myth believing that intraday trading is more profitable than trading off the daily and weekly time frames. That's absolutely incorrect. Okay, it's just not accurate at all. And let me prove you why. Let's assume an intraday trader obviously seeks to take trades every day, all right, on every single trading session. Now, for the sake of discussion, let's assume an intraday trader finds a profitable trade every single day of the week. Now, trust me if I say that that's way more difficult than it sounds. It's easier to be said than done. But again, for the sake of discussion, let's assume an intraday trader finds a profitable trading opportunity every single day of the week. Now, that would be 5 trades per day, all right? Assuming they are all profitable, the typical intraday trading trade, well, seeks to make, I don't know, let's say 30 pips, 40 pips on average. Okay, these are small positions. Okay, intraday trading is all about high frequency trading, shooting for small individual profits per individual position. All right, so 30 or 40 pips per trade. Let's round it up to 35. All right, 5 times 35, this is 175 pips, if I am not mistaken, 175 pips per week. Now, there are 4 weeks in the month. It's 20, 28, 30, 700 pips. All right, that's 700 pips in profit per month on average as an intraday trader. Now, a trader who bases his or her trading decisions off the daily and weekly time frame, well, you are looking to take, as an average, in my experience, 3 or 4 trades per month. All right, 3 or 4 trades per month. I know it doesn't sound that much, or that many actually, but that's more or less what you are looking to, the number of trades you are looking to take as a long-term trader. Now, 3 or 4 trades per month, obviously you are not going to be shooting for 35 pips per trade. If the longer time frame you are basing your decisions off, the longer, or the larger the profit potentials, right? So as an average, in my experience, you are shooting for around 200 to 250 pips per individual position. All right, now you do the math. I mean, 3 or 4 trades per month, aiming for 200, 250 pips each, you do the math. It's at least as profitable as intraday trading. At the end of the month, the bottom line is that you are gonna come out just as profitable with an equal number of pips, either if you trade a high number of trades shooting for small profits per position, or if you take few trades shooting for large potential profits per position. All right. At the end of the month, again, do we trade for the sake of trading, or do we trade for the sake of profits? Again, I know that intraday trading may sound more exciting, more entertaining, but hey, we are not trading forex to have fun. Okay, we are not trading forex to entertain ourselves. We are trading forex to make profits. And the truth is that at the end of the month, the profits are more or less about equal. All right. So that's one myth that I really wanted to dispel here. Another piece of information that I usually see discussed over and over of the internet forums is that trading off the daily and the weekly charts carries a higher degree of risk, since the size of the stop losses are usually larger. Well, obviously that's totally incorrect, and over the following videos you will see why. But like I say, it's certainly not correct at all. In fact, quite the opposite. Intraday trading does carry indeed a higher degree of risk for multiple reasons. For starters, the quality of the signals that you get on the intraday charts is usually a lower quality than those you get from the long-term charts. There's just too much market random noise on the intraday charts. Price action reading is more difficult. Price is more volatile, right? And gauging the validity of a trading signal is more difficult on the 5 minutes, 15 minutes time frame than on the daily or the weekly. Moreover, we have the news announcements. As you probably know, the market is hit by multiple news announcements on a daily basis, and they can easily spike price. Okay, you can easily spike price 50 pips. All right, within the minute, literally within the minute. Okay, those 50 pip price spikes are massive. They create huge impact on the intraday charts. All right, from an intraday point of view, for an intraday trader, a 50 pip random spike on your chart can easily make the difference between a winning trade and a losing trade, since 50 pips is usually enough to hit your stop loss this quick. However, 50 pips for a trader who bases his trading decisions off the daily and the weekly time frames, quite frankly, that's just a small wiggle on your chart. Okay, it's gonna make no impact whatsoever on your trading routine. So whereas intraday traders need to really pay attention to news announcements, to us long-term traders, we really pay no attention. We shouldn't be concerned at all. Now, another important point, not only long-term trading or trading off the longer time frames is just as profitable, less risky than intraday trading, but also is more efficient. And I'm talking about spread costs here. Now, as you probably know, the spread is the entry fee, the commission cost you need to pay every time you trigger a trade. All right. Well, let's go back into our previous hypothetical case in which a intraday trader took 5 trades per week, shooting for 175 pips in profits. The spread varies quite a lot depending on what currency pair you're trading, but on a standard currency pair, for example, I don't know, the sterling pound against the American dollar, you are looking to pay between 2 and 3 pips of a spread depending on your broker. Okay, so 5 trades time 3 pips equals 15 pips at the end of the week just on commission. All right, 15 pips to make 175 pips of profits. Now, a trader who bases his trading decisions off the daily and weekly time frame seeks to make between 200 and 250 pips per individual trade. Now, since he only needs one bullet, one shot to make those 200 pips to round it up, he's just going to take one trade, all right? Times 3 pips equals, obviously, 3 pips. Well, which one seems more efficient to you? 15 pips of commissions to make 175 or 3 pips to make 200? All right. Obviously, intraday trading is way less efficient as per the commission cost. There is no way around that. So that's another plus for moving on to the daily and weekly timeframes as a part-time trader. But there's another bonus as far as efficiency goes, and it's actually more important than cutting down on your commission costs, and that's the how wide your range of options is going to be as far as the different currency pairs you can have access to. Let me try to explain what I mean here. There are some particular currency pairs, such as, I don't know, the euro against the New Zealand dollar, the the sterling pound against the Canadian dollar, the Australian dollar against the Canadian dollar, the euro against the Australian dollar, etc., etc. There are quite a few different currency pairs where the spread cost is a little bit higher than usual, and they can span from 7 pips to, well, up to 10, even 12 pips, depending on what broker you are using, okay? But yeah, between 6, 7, 8, 10 pips, of spread cost. Well, as an intraday trader, if you should for 35 or 40 pips per individual position, do you think it's a good idea to pay 10 pips to, as an entry commission, all right? He has to shoot for 40 pips. That means that 25% of your trade goes entirely to pay for the commission cost. That's insane. That's very, very inefficient. So, as a result, intraday traders have a shorter range of options as far as what currency pairs they can trade. They cannot really pay 10 pips from an intraday point of view. It's just too expensive, too inefficient. So they need to narrow down the number of different currency pairs they can trade. Now, obviously, as a long-term trader who is making 200 pips on average per position, well, it is okay to pay 10 pips if you are shooting for 200. All right, 10 pips out of 200 is just 5%. Okay, only 5% of the trade. Okay, 5% of 200 is 10 pips. Anyway, so you can really pay 10 pips. You don't care about 10 pips if you are shooting to make, or if you are aiming to make 200 out of that position as a whole. All right. So as a result, what does that mean? Well, the consequence is that you are gonna broaden up. You're going to expand the number of currency pairs, the number of currency pairs you're going to be searching for trading opportunities on. All right, you are going to open yourself to a whole new bunch of currency pairs that you just didn't have access to. I mean, you did have access to, but it was not efficient as an intraday trader. All right, you're going to be trading stuff like, again, the euro against the New Zealand dollar, the sterling pound against the New Zealand dollar. The Australian dollar against the Swiss franc, currency pairs that are usually not usually traded that much from an intraday point of view, but as a long-term trader, you will indeed be able to search for trading opportunities on those currency pairs. And again, as a result, you're going to be able to find more trading opportunities. Obviously, the more trading instruments you follow, you monitor, well, the more trading opportunities you're going to find. So, as you can see, there are so many reasons to move away from the intraday charts if you are to become a part-time trader. I mean, if you are to become a full-time trader, sure, go ahead and specialize on intraday trading. There is nothing wrong with that. But if you are looking to spend 20, 30, 45 minutes of your day, only 20, 30, 45 minutes of your day in front of your charts, moving away from intraday trading is the best decision you can take. Okay, trust me on this one, guys. I've seen plenty of part-time traders getting burned on the intraday charts, and it's just not their battlefield. Their battlefield should be the long-term charts. So throughout the following videos, we are going to be focusing on strategies that specialize on the daily and weekly time frames, on occasion on the monthly, but especially on the daily and weekly time frames. Those time frames are going to be our bread and butter, okay, as part-time traders. And again, trust me, it's going to be a good decision for you, okay, as a part-time trader. And on top of that, it's going to cut down on your stress levels. All right, your trading experience is going to be much more pleasant. Okay, and all in all, as I was mentioning before, you are going to be just as profitable, and you're going to be more efficient as a trader. All right, so it's a win-win situation.